Welcome back to our CA Final IDT revision series. In this session, we'll continue our discussion on levy and exemptions by focusing on some highly tested topics, including re-import exemptions, valuation of repaired goods, treatment of goods abandoned at sea, and the customs import of goods at concessional rate of duty rules 2022, commonly known as the IGCR rules. These provisions are particularly important because they combine conceptual understanding with procedural compliance. Many students focus only on the charging provisions, but examiners often test the conditions, timelines, documentation requirements, and recovery mechanisms discussed in this chapter. Let's simplify these concepts and make them easy to remember. Before we begin, let's understand the key learning objectives of this session. First, we'll study Notification 158 of 1995, which provides exemptions for re-imported goods sent abroad for repairs or processing. Next, we'll learn how to calculate customs duty when repaired goods return to India. Then we'll examine the treatment of goods lost or abandoned at sea under Section 21 and understand important maritime definitions frequently asked in MCQs. Finally, we'll explore the IGCR rules 2022, including their applicability, procedural requirements, compliance obligations, and recovery provisions. Together, these topics form an important scoring area within customs law. Notification. No 158/95 grants complete exemption from basic customs duty and IGST on certain Indian manufactured goods that are re-imported into India. However, this benefit is available only when strict conditions are satisfied. The goods must have originally been manufactured in India and must qualify under one of the specified categories covered by the notification. Additionally, the importer must comply with prescribed time limits, establish the identity of the goods to the satisfaction of customs authorities, and fulfill various procedural requirements, such as execution of bonds. This notification is designed to prevent unnecessary tax burden when Indian goods temporarily leave the country and subsequently return. Let's understand the first two categories covered under Notification 158/95. Category A applies to general goods sent abroad for repairs or reconditioning. Such goods must be re-imported within 3 years from export, although the period extends to 10 years for Nepal and Bhutan. After re-importation, they must be re-exported within 6 months, extendable up to 1 year. Category B covers goods sent abroad for reprocessing, refining, remaking, or similar operations. These goods must return within 1 year from export. An important benefit is that any loss occurring during the processing operation may also qualify for duty exemption, provided customs authorities are satisfied. Category C deals with specified goods such as automatic data processing machines, telecom equipment, medical devices, and similar products. These goods are often expensive and technologically sophisticated, requiring special treatment. For this category, their import period is 7 years from exportation, which extends to 10 years for Nepal and Bhutan. Once re-imported, the goods must be re-exported within 1 year. The importer must establish the identity of the goods to the satisfaction of the assistant or deputy commissioner and execute the prescribed bond. For exam purposes, remember Category C separately because its timelines differ from the other categories. Now let's discuss Notification 45/2017, which applies when goods are exported for repairs abroad and subsequently re-imported. The principle here is simple. Customs duty should apply only to the value added through repairs and not to the entire value of the goods. To avail this benefit, 3 conditions must be satisfied. First, the goods must be re-imported within 5 years, extendable by 2 additional years. Second, the identity of the goods must remain unchanged. Third, ownership of the goods must remain with the same person. Once these conditions are fulfilled, duty is calculated only on repair-related value additions. The valuation mechanism for repaired goods is highly important for practical questions. The assessable value consists of the fair cost of repairs, including the value of materials used, even if the repairs were carried out free of charge under warranty. To this, we add actual insurance and freight charges for both outward and inward journeys. Once the assessable value is determined, basic customs duty is calculated. Social welfare surcharge is then applied at 10% of the BCD. Finally, IGST is levied on the aggregate amount. A useful exam formula is fair repair cost plus two-way freight and insurance equals assessable value. Section 21 deals with goods abandoned or lost at sea. The law treats such goods as if they were imported into India, even though their arrival may not have been intentional. Consequently, customs jurisdiction applies, and duty becomes payable unless a specific exemption is available. The burden of proof lies on the importer or claimant to establish that the goods qualify for duty-free admission. The underlying principle is that entry into Indian customs territory cannot escape taxation merely because the circumstances were accidental. This provision ensures effective customs control over all goods that ultimately come within India's jurisdiction. This slide contains some of the most popular MCQ definitions in customs law. A derelict refers to a vessel or cargo abandoned in the sea with no hope of recovery. Jetsam refers to goods deliberately thrown overboard to save a vessel from sinking, and these goods sink. Flotsam refers to goods similarly thrown overboard, but which continue floating on the water. Finally, wreck refers to cargo or property cast ashore by tides following a shipwreck. A simple memory trick is, Jetsam sinks, Flotsam floats. These definitions are short, frequently tested, and worth memorizing exactly as stated in the law. The customs import of goods at concessional rate of duty or for specified end-use rules, 2022, commonly called the IGCR rules, provide the administrative framework for availing concessional customs duty benefits. The CIR rules apply when a notification specifically requires compliance with them, or when imported goods are intended for manufacturing a commodity, providing an output service, or being put to a specified end use. The objective is to ensure that concessional imports are actually utilized for the intended purpose. Therefore, while exemptions reduce duty, the IGCR rules ensure accountability, monitoring, and proper utilization of imported goods. Several important definitions under Rule 3 form the foundation of the IGCR rules. Capital goods are goods whose value is capitalized in the importer's books of account. Job work means processing, treatment, or manufacturing performed on goods belonging to the importer, although precious metals, jewelry, and certain stones are excluded. Manufacture refers to a process resulting in a new product with a distinct name, character, or use. Other important definitions include output service, specified end use, quarter, and jurisdictional customs officer. Understanding these definitions is essential because they determine how the procedural provisions apply in practical situations. Before availing concessional duty benefits under the IGCR rules, the importer must provide one-time prior information through the Common Portal. This information includes importer details, job worker details, manufacturing processes, descriptions of imported goods, applicable exemption notifications, intended ports of import, and end-use information. Once the information is successfully submitted and accepted, the system generates an import of goods at concessional rate identification number, commonly known as the IIN. This number becomes the importer's unique identifier for IGCR compliance and must subsequently be quoted in customs documentation and future procedural filings. Along with prior information, the importer must execute a continuity bond with the jurisdictional deputy or assistant commissioner of customs. The purpose of this bond is to protect government revenue if the importer fails to comply with notification conditions. In cases involving duty exemption notifications, the bond covers the difference between normal duty and concessional duty, along with applicable interest. For certain other notifications, the bond amount may equal the assessable value of imported goods. Interest is calculated from the date of import until the date of actual payment. This mechanism ensures accountability while allowing concessional imports. Once goods arrive in India, the importer files the bill of entry and must mention both the IIN and continuity bond details. Upon clearance of goods for home consumption, the customs automated system automatically debits the continuity bond. This electronic process ensures seamless tracking of imports and eliminates the need for extensive manual monitoring. The details are simultaneously routed to the jurisdictional customs officer for oversight and verification. The entire process demonstrates how technology has streamlined customs administration while maintaining control over concessional imports and ensuring compliance with prescribed conditions. Rule 6 imposes important compliance requirements. The importer must maintain detailed records showing quantities and values of imported goods, dates of receipt, consumption details, stock balances, job work movements, exports, and end-use utilization. Any shortages or short receipts must be immediately reported through the Common Portal. Most importantly, a quarterly statement must be filed by the 10th day of the month following the relevant quarter. A useful benefit is that importers can submit consumption details earlier and obtain immediate recredit of their bond. For examinations, always remember the filing deadline, the 10th day of the following quarter. The IGCR rules allow imported goods to be sent for job work, but strict controls apply. Goods must move under an invoice or e-way bill, as prescribed under the GST law. Such movements must be properly recorded and disclosed in the quarterly statement. A crucial condition is that goods can remain with the job worker for a maximum period of 1 year from the invoice or e-way bill date. The job worker must maintain records of receipts, processes performed, and waste generated. However, the ultimate responsibility for proper utilization and compliance always remains with the importer. Rules 8 and 9 deal with movements after importation. Under Rule 8, goods may be transferred to another unit of the importer, provided proper documentation such as invoices or e-way bills is maintained, and the movement is reported in records and quarterly statements. Under Rule 9, goods may be supplied to specified end-use recipients. These recipients must maintain production and waste records and provide the necessary details to the importer. The overall objective is to create a traceable audit trail so that concessional imports can be monitored from importation to their final utilization. Rule 10 provides options when imported goods remain unutilized or become defective. Normally, goods must be used within the period specified in the exemption notification or within 1 year from import, with a possible extension of 3 months. The importer may choose to re-export the goods, ensuring that the re-export value is not less than the import value. Alternatively, the importer may clear the goods for home consumption by voluntarily paying the applicable duty and interest. In either case, the action must be properly disclosed in the quarterly statement for compliance purposes. When capital goods imported under concessional duty schemes are eventually cleared for home consumption, duty is calculated on a depreciated value basis. The straight-line method is used, and even part of a quarter is treated as a full quarter. Depreciation is allowed at 4% per quarter during the first year, 3% per quarter during the second and third years, 2.5% per quarter during the fourth and fifth years, and 2% per quarter thereafter. These rates are extremely important for numerical questions, so students should memorize them carefully for examination purposes. The final provision deals with recovery proceedings. If the importer fails to comply with the IGCR rules, violates prescribed conditions, misses time limits, or fails to pay applicable duties and interest, the Deputy or Assistant Commissioner of Customs may invoke the continuity bond. For exemption-based notifications, the recovery amount consists of the duty difference plus interest calculated under Section 28AA from the date of import until actual payment. For certain other notifications, recovery may extend to the full assessable value of imported goods. This provision acts as the enforcement mechanism ensuring that concessional benefits are not misused. Welcome to this CA Final Customs Revision session on Levy and Exemptions. In this part, we will cover some of the most exam-relevant customs provisions, including assessment of duty, determination of the correct rate of duty under Section 15, relief available for pilfered, damaged, lost, or abandoned goods, and the exemption powers of the government under Section 25. These provisions are frequently tested in both theory and practical questions. Rather than memorizing sections mechanically, we'll understand the logic behind each provision, so that application in exam scenarios becomes much easier and more intuitive. Before diving into the provisions, let's understand the roadmap of this chapter. We will begin with the concept of customs assessment and the 4 mandatory stages involved in determining duty liability. Next, we'll study Section 15, which determines the relevant date for applying the rate of duty and tariff valuation. We will then compare 3 important relief provisions: Section 13 for pilferage, Section 22 for abatement on damaged goods, and Section 23 for remission and abandonment. Finally, we'll discuss denaturing and mutilation under Section 24 and the exemption powers granted to the central government under Sections 25, 25A, and 25B. In customs law, assessment simply means determining the exact amount of duty payable by the importer. This process follows 4 strict stages. First, customs authorities determine the quantity and value of the imported goods. Second, they identify the correct tariff classification, because duty rates vary across different products. Third, the applicable rate of duty is determined after considering exemptions, abatements, and remissions. Finally, customs decides whether the goods will be cleared for home consumption or stored in a warehouse. Remember, assessment is essentially a systematic process of quantifying duty and is different from valuation under Section 14. Section 15 is one of the most practical and examination-oriented provisions in customs law. Its purpose is not to determine the value of goods, but to identify the correct date for applying the rate of duty and tariff valuation. For goods imported directly for home consumption, the relevant date is the later of 2 dates, the date of filing the bill of entry or the date of entry inward of the vessel or arrival of the aircraft. For warehoused goods, the relevant date is the date on which the ex-bond bill of entry for home consumption is filed. For all other cases, the date of payment of duty becomes relevant. Let's see how Section 15 works in practice. Suppose an importer files a bill of entry on January 1st, but the vessel arrives only on January 3rd. Since the law requires the later date, January 3rd becomes the relevant date for duty determination. Now consider warehoused goods. Imagine goods were stored when the duty rate was 40%, but later an exemption reduced it to 25%. If the importer files the ex-bond bill of entry after the exemption becomes effective, the lower rate of 25% applies. This is why determining the correct relevant date is extremely important in customs calculations. Section 13 provides relief when imported goods are pilfered, meaning stolen in small quantities. The basic principle is simple. If the importer never receives the goods because they were stolen while under customs custody, the importer should not bear the duty burden. However, 3 conditions must be satisfied. First, actual pilferage must occur. Second, it must happen after unloading but before the clearance or warehousing order is passed. Third, the goods must not be restored to the importer. If the goods are later recovered and returned, duty becomes payable. Remember, Section 13 deals only with petty theft, not complete loss of goods. Section 23(1) covers situations where imported goods are completely lost or destroyed due to reasons other than pilferage. Examples include destruction by fire, floods, accidents, or other natural causes. Since the goods no longer exist and cannot be recovered, customs authorities remit the duty liability. The loss can occur at any time before actual clearance for home consumption, even if duty has already been paid. This provision also applies to goods stored in warehouses, which is a major difference from Section 13. However, the importer must prove the loss or destruction to the satisfaction of the Assistant or Deputy Commissioner. Section 23(2) gives an importer the option to voluntarily relinquish ownership of imported goods. By surrendering title to the goods, the importer avoids paying customs duty. This option is commonly used when goods do not meet specifications, are damaged during transit, or when the underlying contract fails. However, timing is crucial. Relinquishment must occur before the order for home consumption clearance under Section 47 or warehousing under Section 60. The importer must endorse the title documents in favor of customs authorities. One important exception is that abandonment is not permitted if an offense under customs law appears to have been committed. Students often confuse Sections 13 and 23, so understanding the distinction is critical. Section 13 applies to pilferage, which means petty theft occurring after unloading but before customs clearance. In such cases, the importer is simply not liable to pay duty. Section 23, on the other hand, applies when goods are completely lost, destroyed, or voluntarily abandoned. Here, duty is remitted. Another key distinction is that Section 13 does not apply to warehoused goods, whereas Section 23 does. Also, under Section 23, the importer must prove the loss, whereas pilferage is usually evident during customs examination. Section 22 deals with a situation where goods are neither fully available nor fully lost. Instead, they are damaged or deteriorated, resulting in a reduction in value. In such cases, customs grants abatement, meaning a proportional reduction in duty. The damage may occur before unloading, during unloading, after unloading but before assessment, or while goods are stored in a warehouse. However, the damage should not be caused by the willful act, negligence, or default of the importer or owner. Since the goods still retain some value, complete remission is not granted. Instead, duty is reduced proportionately to the reduced value. A simple way to remember these provisions is through the extent of loss suffered. Section 13 applies when goods are stolen in small quantities through pilferage. Section 22 applies when goods remain available but suffer damage or deterioration, reducing their value. Section 23 applies when goods are completely lost, destroyed, or abandoned. Think of it as 3 levels of relief. Pilferage leads to no duty liability, damage leads to reduced duty, and total loss leads to complete remission. In practical questions, identifying whether the goods are partially damaged or completely lost often determines the correct section and the marks you score. Section 24 applies to goods that can be used for multiple purposes and attract different duty rates depending on their use. At the request of the owner, customs may permit denaturing or mutilation so that the goods become unfit for a particular higher duty purpose. Once altered, the goods are taxed according to their new form. A classic example is ethyl alcohol. Since it can be used for human consumption or industrial purposes, duty rates differ. By adding denaturants and making it unfit for human consumption, the importer can qualify for the lower industrial duty rate. This provision prevents misuse while ensuring appropriate taxation. Parliament has delegated exemption powers to the central government through Section 25. Under Section 25(1), general exemptions are granted through notifications published in the Official Gazette whenever the government considers it necessary in public interest. These exemptions may be absolute or conditional. Under Section 25(2), special exemptions are granted through individual orders in exceptional circumstances where public interest exists. Such orders apply to specific cases rather than the public at large. Another important point is the threshold benefit under which customs duty is not collected if the duty amount payable is 100 rupees or less. The sunset clause is an important safeguard applicable to conditional exemptions. It ensures that such exemptions do not continue indefinitely without review. Under this rule, a conditional exemption automatically expires on the 31st of March, falling immediately after 2 years from the date it was granted or modified, unless specifically extended or withdrawn earlier. However, several exceptions exist. The clause does not apply to trade agreements, international treaties, diplomatic privileges, foreign trade policy schemes, long-term government schemes, re-imports, temporary imports, gifts, baggage, and certain other customs duties. Questions on these exceptions are common in examinations. Sections 25A and 25B facilitate international processing arrangements. Section 25A deals with inward processing, where goods are imported into India for repair, processing, or manufacturing and later re-exported. To claim exemption, the goods must be re-exported within 1 year and remain identifiable. Section 25B covers outward processing. Here, goods are exported abroad for repair, processing, or manufacturing and subsequently re-imported into India. The re-import must occur within 1 year, and the goods must be identifiable as the same goods originally exported. These provisions encourage efficient cross-border manufacturing and repair activities without imposing unnecessary duty burdens. Let's quickly revise the chapter. Assessment involves 4 mandatory stages: quantity and value, classification, duty rate determination, and clearance destination. Section 15 identifies the relevant date for applying duty rates. Section 13 covers pilferage. Section 22 covers damage and deterioration. And Section 23 covers total loss, destruction, or abandonment. Section 24 allows denaturing or mutilation to obtain the appropriate duty treatment for dual-purpose goods. Section 25 empowers the government to grant exemptions, while the Sunset Clause limits conditional exemptions. Finally, Sections 25A and 25B support inward and outward processing by providing customs relief for temporary cross-border movements of goods. Welcome to this final segment of Unit 2 on Levy and Exemptions. In this video, we shift our focus from statutory provisions to judicial interpretation. While sections and notifications tell us what the law says, courts tell us how the law should be understood and applied in real-life situations. These landmark Supreme Court decisions form the foundation for interpreting exemption notifications and are highly relevant for CA final examinations. Understanding the principles laid down in these judgments will help you solve descriptive questions and case studies with confidence, rather than relying on rote memorization of case names. This session revolves around 4 major themes that repeatedly appear in examination questions. First, we will understand the nature and validity of exemption notifications and the meaning of public interest. Second, we will discuss who bears the burden of proving eligibility for an exemption. Third, we will explore the rules of interpretation, including the famous distinction between strict and liberal construction. Finally, we will study the rights available to assessees, including claiming exemptions at a later stage and choosing the most beneficial exemption when multiple notifications are available. Together, these principles form the backbone of exemption jurisprudence. A common misconception is that exemption notifications are separate from the Customs Act. The Supreme Court has clarified that exemption notifications are actually part and parcel of the enactment itself. Their purpose is to further the objectives of the parent legislation and not to operate independently. Therefore, a notification must always remain within the powers granted by the Customs Act and must not violate constitutional principles such as equality under Article 14. The landmark case of UOI versus Polywall Electricals established that exemption notifications cannot go beyond the statutory framework and must always operate within constitutional limits. Section 25 empowers the central government to grant customs exemptions whenever it considers such action necessary in the public interest. But what exactly is public interest? The courts have explained that it refers to an act beneficial to the general public, or one undertaken for a public purpose. Importantly, unless the notification specifically indicates otherwise, the term public refers to the Indian public. The landmark judgment in MJ Exports versus Collector of Customs clarified that exemptions granted under Section 25 should generally be interpreted as measures intended to benefit India and its people, rather than serving private or foreign interests. One of the most important principles in exemption law is that the burden of proof lies entirely on the person claiming the exemption. The Revenue Department is not required to prove that an assessee is ineligible. Instead, the assessee must establish eligibility. This principle was firmly established in cases such as Mysore Metal Industries and Motiram Tolaram. Think of an exemption as a special privilege rather than a default right. If someone wishes to enjoy that privilege, they must demonstrate that all required conditions have been satisfied. In practical questions, always ask whether the assessee has adequately proved eligibility before granting the exemption. Merely asserting eligibility is never sufficient for claiming an exemption. Courts require concrete evidence and supporting materials. According to the rulings in BOC India Limited and Harichandra Sri Gopal, the assessee must bring sufficient records and documents to establish beyond doubt that the transaction falls within the scope of the exemption notification. In other words, eligibility must be explicitly demonstrated rather than assumed. Whenever you encounter a case study, examine whether the facts and documents provided are adequate to satisfy the notification's requirements. Lack of evidence often becomes the deciding factor in exemption disputes. The starting point for interpreting any exemption notification is the plain meaning rule. The Supreme Court has repeatedly stated that notifications should be read in the same way an ordinary person would read them. In the Shibani engineering case, the court emphasized that straightforward language should be understood according to its natural meaning. Similarly, the Nova Pan judgment clarified that interpretation becomes necessary only when there is genuine ambiguity regarding legislative intent. If the words are clear and unambiguous, there is no need for strict or liberal interpretation. Simply apply the notification exactly as it is written. Courts have consistently warned against artificially expanding the scope of exemption notifications. In the Rajasthan Spinning and Weaving Mills case, the Supreme Court held that no extended meaning can be given to an exempted item merely to enlarge the benefit. In simple terms, if the notification covers a specific item, taxpayers cannot stretch the definition to include similar but non-qualifying items. Exemptions are intended to operate within clearly defined boundaries. Therefore, whenever you analyze a case study, avoid broad interpretations that attempt to create eligibility, where the notification itself does not expressly provide it. One of the most important judicial principles for examinations comes from the Wood Papers case. The Supreme Court developed a two-stage interpretation process for exemption notifications. Many students remember strict and liberal interpretations separately, but fail to understand when each applies. The court clarified that both approaches are correct, but they apply at different stages. First, determine whether the assessee falls within the exemption notification. Then, once eligibility is established, determine how the notification should be applied. Understanding this distinction can significantly improve your performance in exemption-related case studies and descriptive questions. The first stage is known as the applicability test. At this stage, the notification must be interpreted strictly. The objective is to determine whether the assessee genuinely qualifies for the exemption. If there is ambiguity regarding eligibility, the benefit of doubt goes in favor of the revenue and against the assessee. In other words, the assessee must clearly demonstrate that all eligibility conditions have been met. Courts do not permit broad or generous interpretations at this stage. The threshold for entering the exemption notification must be crossed through strict compliance with the specified requirements. Once eligibility has been conclusively established, the approach changes completely. This second stage focuses on applying the exemption rather than determining eligibility. Here, courts favor a liberal interpretation so that the intended benefit is fully enjoyed by the eligible assessee. The rationale is simple. Once it is clear that the taxpayer belongs within the exemption category, unnecessary technical restrictions should not defeat the objective of the notification. Therefore, the same notification that is interpreted strictly at the entry stage may be interpreted liberally at the benefit stage. This distinction is the essence of the Wood Papers principle. Not all conditions within an exemption notification carry the same importance. The Supreme Court in Harichandra Sri Gopal distinguished between mandatory and directory conditions. Mandatory conditions are eligibility requirements and therefore require strict compliance. Failure to satisfy them results in denial of the exemption itself. Directory conditions, on the other hand, are procedural or administrative requirements. These may receive a more liberal interpretation if the substantive objective of the notification has been achieved. In examinations, identifying whether a condition is mandatory or merely procedural is often the key to solving complex exemption-related case studies correctly. Legal consistency is another important principle established by the courts. Expressions used in the Customs Act must carry the same meaning when they appear in rules, regulations, or exemption notifications. Once a term has been defined in the parent statute, that definition continues to apply throughout subordinate legislation. The Supreme Court confirmed this principle in Prestige Engineering India Limited. This ensures uniform interpretation and prevents confusion arising from different meanings being assigned to the same expression. Whenever you encounter a defined term in a notification, your first step should be to check whether that term has already been defined in the Act itself. An assessee does not permanently lose an exemption merely because it was not claimed at the earliest opportunity. In the Share Medical Care case, the Supreme Court held that failure to claim an exemption initially does not create a bar against claiming it later. The assessee is neither debarred nor estopped from seeking the benefit subsequently. This principle protects substantive rights over procedural lapses. Therefore, if the facts ultimately establish eligibility, the exemption can still be claimed even after the initial stage. This judgment is particularly useful in practical questions involving omissions or oversights during customs clearance. Sometimes two different exemption notifications may simultaneously apply to the same transaction. In such cases, who decides which notification should be used? The Supreme Court answered this in the Indian Petrochemicals case. The assessee has the right to choose whichever notification is more beneficial. The Revenue Department cannot force the taxpayer to adopt the notification, resulting in a higher tax liability. This principle recognizes that exemption notifications are intended to provide relief, and where multiple lawful options exist, the taxpayer may select the one that provides the greatest advantage. This rule frequently appears in examination case studies. When solving exemption-related case studies, follow a structured approach. First, identify whether the issue concerns eligibility or application, because that determines whether strict or liberal interpretation should be used. Second, verify whether sufficient evidence exists to establish entitlement. Third, avoid extending the language of the notification beyond its natural meaning. Fourth, distinguish between mandatory eligibility conditions and directory procedural conditions. Finally, check whether the assessee can claim the benefit later or choose between multiple applicable notifications. Following this sequence helps convert complex legal principles into a practical framework for answering examination questions. Let's conclude with a quick revision. Exemption notifications form part of the enactment and must operate within constitutional and statutory limits. Public interest under Section 25 generally refers to benefits intended for the Indian public. The burden of proving eligibility lies entirely on the assessee. Apply the plain meaning rule first, and avoid extending exemption language beyond its scope. Remember the Wood Papers principle: strict construction for determining eligibility and liberal construction for granting the benefit after eligibility is established. Finally, assessees can claim exemptions later, and may choose the most beneficial notification when multiple options are available. Mastering these principles will help you confidently tackle CA final IDT case law questions.